Ascending Scallop Chart Pattern. This chart pattern will make you billionaire. The ascending scallop pattern is one of the most profitable chart patterns that I frequently use for day trading. But for some reason, I still see many traders confusing and fumbling around trying to figure it out. How many times have you been stopped out with a scallop formation? If you're like most traders, the answer is probably, way too many. It's frustrating. I know you feel like you're putting in a lot of effort, but you're not making any progress whatsoever. And the good news is, you can master this pattern without too much trouble. All you have to do is find the right trading strategy that works for you. But most importantly, you'll learn the best way to start making consistent profits from trading scallop patterns. Now, let's get started. What is ascending scallop chart pattern? An ascending scallop pattern is a bullish continuation pattern that appears near the top of an uptrend. It's characterized by a rising price trend, followed by a short-term retracement, and then another rise to form a higher peak. You can notice that the upward move after a throwback is usually faster than the previous one, which adds to the bullish sentiment in the market. This momentum leads to uptrend is likely to resume with a sustained move above the previous highs. An upward breakout occurs when prices break up through the resistance trend line with rising volume. Remember that the price must close above this resistance boundary to confirm a valid breakout, otherwise you may end up getting caught in a bull trap. How to trade. 1. Ascending scallops pattern is observed during a bullish rally. 2. This pattern appears to be in the shape of J, slightly tilted to its right. 3. There is a price drop at the start of the pattern. The drop is less and it reverses back, forming a wider bottom. 4. After reversal, the price continues to rise further and the whole pattern appears as tilted J. 5. There can be a breakout in either direction, i.e., there is a chance of trend reversal and trend continual. 6. A breakout above the highest high is considered as an upward breakout, whereas a breakout below the pattern's low is treated as a downward breakout. 7. A breakout is necessary to confirm the pattern. 8. Compute the height difference between the highest high and the low of the pattern. 9. Add the value to the highest peak to get the upward breakout price target. Similarly, subtract the value from the lowest valley to get the downward breakout price target. 10. Price often forms another scallop when it peaks towards the right, forming a handle shape. Traders can initiate their long positions at the low of the new scallop. Their stop loss would be little below the bottom of the new scallop. 11. If no such handle shape is formed, the stop can be placed below the bottom of the pattern and it can be raised as the price rises. 12. If there is a downward breakout, traders can initiate their short position and their target would be the same as the above calculated downward breakout price target. 13. As the trend end approaches, the scallops become shorter and narrower. 14. Ascending scallops perform the best when they are formed in the middle of the yearly price range. Summary. There you have it, the most detailed guide on how to trade scallop patterns profitably. Now that you know all about them, it's time to put the knowledge into practice by testing them out on your charts. Remember, the best trader in the world can lose all his money if he makes the wrong decision. So make sure you always trade with a stop loss to protect your capital. Your stop loss and take profit points can be set based on your risk to reward ratio, but make sure that you don't put them near your entry point. Trade safe and good luck.